G'day Money Miners, we've got an exciting chat here with the King of Copper, Ahmad, and speaking of the kings of industry, use Axis Mining Technology, the kings of drill hole orientation and surveying. Give Shaun a call, they always pick up the phone.
Not good enough, JD. It goes like this. Axis Mining Technology are the trusted advisor in drill hole survey instrumentation. You need more Axis in your life because you just know exactly where everything is in space.
Thank God you popped up, Matty.
I'll hand it back over.
So let's get into some copper now. Ahmad, thanks for coming on.
No worries. I'm going to say the same thing I say every time I come on here. You're only as good as your last performance. So if I bomb here, you'll never see me again. So.
You're putting the pressure on yourself there. So we've been planning actually this copper chat for quite a while. It's an exciting one for so many different reasons. There's so many big companies, small companies, analysts, buy side, sell side, that are just bullish about copper, and it's a super interesting space. You got from a geological perspective, different deposits. Yep. You've got from the smallest miners to the biggest out there looking for these projects. It's probably the most reported about metal, I'd say, bar none out there. So I'm very excited, and I think the kind of logical place to start this discussion is exactly there, just talking about those demand projections that we're seeing, how the world is kind of going to get there, whether those projections are in fact going to eventuate. So, plonking that all on you, I want to kind of hear, what do you make of this whole, there is a complete dearth of copper projects out there kind of discussion point?
I mean, I think as far as commodities goes, I don't think there is a higher premium in any commodity right now for finding a significant deposit than copper. I think that is, and a lot of that is driven by the demand, and whether you believe the demand curves, like the timeline of the demand curves, all of those things, you can make a rational argument for both of those sides, right? Like, we are definitely going to use more copper. Are we going to use it as quickly as some people are projecting? Yeah, probably, maybe. Like, copper is kind of directly tied to infrastructure. And in some places, it takes a while to build infrastructure, so I don't think it's going to... you can make a rational argument that some people's projections are aggressive. You can make an argument that some people's projections are conservative. But in the end, I think, to your point, that there is, I think, no other commodity that has an actual as well as a perceived premium tied to finding a deposit that will be a company maker or return significant value.
I don't think we need to sort of flesh out the kind of bull side of it too much. I think the audience, very well understands that is the widely held view.
Yeah.
But I'd love to hear from you, and we were speaking about this before we recorded today, the kind of contrarian take, and there are a few of these out there. There is a few of these sort of takes emerging.
And I think the current view is that, we're not finding enough copper deposits, and that's going to create this gap in the supply demand that we're going to have. And that's true. We are definitely not finding new copper deposits at the same rate that we were, say, 10 years ago or 20 years ago. I guess one of the contrarian views that we talked about, and I guess is the thing that we wanted to talk about here, is that the sexy bit is, I think everyone says that we should make new discoveries. But there's a body of work that's going to come out, and it's not my body of work. It's by two people named Richard Shoddy, who's a consultant under Minex Consulting, another guy named Pietro Gouge, who works at the Center of Exploration Targeting at EWA. And their study will be, it's an upcoming paper in a journal called Geosystems and Geoenvironment, so that'll come out later this year. But Richard will also present this work at IMARC. So if you're going to IMARC, you can go watch his talk. I think it's called What's the Real Story of Copper? And I guess what the work that they've done shows that if you look at existing assets, the resource growth on these existing assets is actually meeting the copper demand that we've had since 2010 till now. So the resources on these existing assets, so we're talking about mines that are already in production, like we call them delineation projects. So they're delineating more resources or adding more resources to the inventory. And that has delivered twice as much the amount of copper as new discoveries have in the last, or since 2010. Wow. So in the last decade or last 15 years now, they've delivered twice as much on existing assets as they have. Now, in that parlance of what we talk about, this is, say, call it brownfields discoveries or,
Expansions, really.
Yeah, resource expansion drilling. And so there's a few things, and like sometimes you call it exploration upside. You have a resource and then you drill it out and it becomes double the size, but the initial resource was what you built the mine on. So new discoveries haven't quite filled the demand that we've had in the past, and they're not likely to fill the demand that we will have in the short term either. Because if you make a copper discovery now, it's probably going to be 10 years if it's a substantial copper discovery or mine for it to come into full production. And 10 years is probably pretty aggressive. It'll probably be somewhere on the order of like 12 to 15 years that realistically that you can kind of put it into production.
And I think QB is the case in point that a lot of people have in their mind, and that was 29 years off the top of my head from when they first discovered it in, I think, 1992 to when it comes online. And
that's right. And there's a lot of these. So, the Lost Bronzes is another Anglo one that was stuck in development hell, kind of like that Hollywood term of development hell for 5 years, I think it was. It still has challenges now. Resolution is another one. It's been stuck in this thing for decades. Several, Supreme Court cases on that stuff.
And these aren't, Chile, they're developed countries, but it's not the quote unquote Western world we're actually talking about. Mm-hmm. And there's been a lot of, arm raising about what's gone on in Australia in the past couple of weeks and what's been going on in Canada for some time now. But can we just knuckle down for a moment on what's really holding up these projects? So, to start with, it takes a long time to drill them out and actually get a solid understanding, right?
Yep.
And then following that, you've got the same as in Australia. You need to get native title, right? Yep. You need to get government approvals. Water is a big challenge.
Yep.
Are there specific areas that you think or challenges that are underweighted by the market at the moment that just take a long time?
I guess this is more
I guess it's more a porphyry type question.
So I think that the two major challenges in porphyry tend to be usually community or environment. They tend to be. And environment, I'll use the bucket term of water being one as well. Because if you're taking water from one source, you're probably affecting someone else's ability to use that water somewhere else. So things like Pebble is a really big copper deposit that's been stuck in Alaska because it's close to an environmentally sensitive area.
Yeah.
It has native title concerns as well. But I feel we're kind of getting into a point now where community and environmental issues, I think we understand the risk with land access or native title, but I think we're probably now starting to understand that environmentally and community-wise, how these things can be affected, and the environment is, I think, just a function of that. When you build these big mines, you can go to Google Maps and look at how big Escondida or Chuquicamata are. They affect a significant amount of real estate on this earth. So the chance that you're going to affect the environment in a certain way or community in a certain way is just higher when you're building such a big thing.
Yeah. And sort of anecdotally, given your experience in Africa, can you comment on development timelines as they sort of compare with Latin America?
That's a good question. Latin America, I think it's probably becoming harder because, particularly in Chile, the water is an issue. The other is anytime you're building something on the side of a mountain that's 4,000 or 5,000 meters high is problematic as it is.
Who'd have thought?
Just from a labor force, if you're asking people to work at 4,800 meters or something like that, there's a whole another problem that you have to manage. In Africa, I don't think the development challenge is as big, but it's just more jurisdictional in that, the government is not as stable as in places like Chile. So it's always a trade-off. You trade off the fact that you can develop things really quickly because the government is happy to take your development dollars and the revenue that comes out of it. But then the government, it may not have the same residency time as your asset does. And so how you kind of play with that.
Actually, on that jurisdictional risk side of things, and we sort of touched on this in our chat with John Ronsky as well, do you think there's also a bit of another reason why there's a lack of copper discoveries in the last decade is because perhaps more of this sort of copper prospectivity is in these riskier jurisdictions, and mining companies are too scared to go there and commit the dollars and tap into that?
Yeah, completely. I think, like if you're a company like BHP, Rio, Anglo, like your appetite to go into places like the DRC is probably low. Like that's why you see companies like Ivanhoe that go into these places and they find a Chinese kind of SOE that becomes partner with them because their risk appetite is different. So I think that's definitely the case where, I think, like part of the cannibalization of assets in places like Chile and South America is because everyone wants to kind of work there. And so, so everyone's kind of fighting over the same, same assets. So it's the red ocean, blue ocean kind of thing. It's red ocean, there's fixed assets and everyone's kind of fighting over them. And so the risk appetite for people to go and, explore where others aren't, I don't think is as high as it's probably been in the past.
Do you think that's going to change over time? We had a discussion with Shepo, and a former investment banking analyst out of South Africa, and he was very pro the development of places like Zambia. Maybe a bit less so DRC. That's probably one step further in its challenges for a BHP or one of these sorts of companies. But do you see a world where BHP is in Zambia, for example?
Yeah, I think so. To be honest, if you're serious about copper, you're going to have to go to some of these places, right? Now, I would advocate that your whole portfolio shouldn't sit in a jurisdiction like Zambia, but I think you should be able, or you should be willing to take that risk, to go into these places. You should be willing to take the risk and to go to like places like Irian Jaya or like PNG and things like that, because otherwise you're it's kind of like to some degree it becomes a no-sum game. Like you're fighting over the same assets. So if you're happy to pay the premium to kind of push someone else out of the way, like a BHP could probably do that, right? Like they could pay a higher premium and push other bidders out of that kind of race. But that's not a strategy that's going to work for everyone. Like the Techs or the Anglos, like these guys wouldn't be able to go compete against the real big majors if they really had to get in that fight.
So to pull the chat back on the path of where discoveries have sort of happened and where expansion in copper production has happened in the past few decades, I've seen you've put a chart here which we'll chuck up on the YouTube, talking about the changes in cutoff grades and specifically as it relates to some of the biggest operations in the world. Just a handful of these operations can change the landscape or add a huge amount of production in a real global sense. So can you kind of talk us through and like what the takeaways are from your perspective?
Yeah. So you can put this graph up, and this is again from Richard Shoddy's work. So he had this graph where he looked at the top 12 porphyry mines in 1929. And then he showed, so at that time in 1929, they had 50 million tons of contained copper at that time. So 3 billion tons at 1.5% copper. Right. And so then you go to today and today was 2008 in that time. And see these same mines now have more than 61 billion tons of 0.6. Right? And that is purely a function of them dropping the cutoff grade. And so my earlier comment about, existing assets have provided twice as much copper inventory as new discoveries in the last 15 years. One of the things that people will argue is they say, well, is that just a drop in the cutoff grade? Now, from 1929 to now, that definitely is a drop in the cutoff grade. Like we were mining probably 1% copper or 1.5% copper then, and now we're mining, substantially lower grades. But when you look at this inventory over the last 15 years that's been added on existing mines, that hasn't been due to cutoff grade. That's been at pretty much the same kind of average grade that these mines have had for the whole time. So that's not a function of people just dropping cutoff grade and just making the resource bigger. That's a function of them just finding the similar material they're mining, but just more of it. And the point of it was that if you look at these top 12 mines in 1929, I think it's like 8 or 9 of them are still in production now. All right, so so for example, Bingham Canyon is still in production, Chuquicamata is still in production,
Morenci,
El Teniente, Morenci,
Miami.
So a lot of these are still operating, and this kind of goes back to I guess one of the other things that we'll kind of get into is that like, why do big companies look for these things? Right? It's because they exist for 100 years, and you can keep mining them for essentially 100 years, and because you'll keep finding more and more material. Like, for example, in this chart that Rich has made, like, you look at it and you go, so the total resource in 1929 in these top 12 mines was 50 million tons. And so from 1929 till now, we have mined 136 million tons of copper out of those. So we've mined 3 times the amount of resource that was listed, like in 1930, 1929. All right.
So I was just going to say quickly for the benefit of the money miners as well, just explaining what a cutoff grade actually is as well.
So cutoff grade in its like layman's terms is basically your economic threshold above which you think you can make money. So if a cutoff grade, like if you read it, if it says 1%, what you're effectively saying is that any ore material below 1% copper is something you're not likely going to make money on. So that's your economic line. And so as copper prices have increased, that line drops as well. So, say if the unit value of 1 ton of copper increases, you can then mine lower grade material because you're getting a higher unit value out of it, right? And the example of this is like things like diamonds or gold are high unit values, so you can mine less gold for exactly the same economic payoff as mining something like copper.
Perfect.
So I'm very keen to go down the path of M&A and what the major companies are looking for, and Philo, these sorts of things that we've seen lately. But to round out on the point about the shortage, the big question out there, like, are we going to have a shortage? What is the kind of consensus you come to? Perhaps not. I mean, you can maybe break it up into a short, medium, and longer term time frame. I mean,
Richard's and Pietro's work shows that in the short term, existing assets will fill any copper demand we're going to have. Now, that doesn't mean that they're going to like fill this demand forever, right? Like, resources are finite resources. They're not renewable. So at some point they will hit a line where we're not going to mine them anymore, and they're going to shut down. My point is that we don't need. It's not that I'm not saying that we don't need new copper discoveries. I'm just saying that I think we have to be a little bit realistic about that. Our copper discoveries, that this kind of rhetoric that's out there now, that we got to go and find new copper discoveries, are they really going to fill the demand that we have in the short to kind of medium term? I think that's unrealistic. But we do need new copper discoveries to fill the medium to long term kind of demand that we're going to have of copper going forward.
Do you think copper recycling will have any material sort of impact on perhaps filling that more medium to longer term shortage?
I think it will. Recycling, I think, if you look at kind of like when recycling programs work and how they work, I think recycling programs work when your demand is kind of fixed to some degree, right? Like, so you can recycle material and you can fill the fixed demand that you're going to have going forward. I think recycling will never really be a substantial thing if your demand keeps increasing, right? Because and also, I think JD, you made the point, right? Like, a lot of copper goes into infrastructure, so in order to recycle that would suggest that you have to take down infrastructure to use that in new infrastructure. And what we're saying is, we don't have the amount of copper infrastructure; we need to build more. So I'm just not sure recycling is ever going to be a substantial amount in that sense.
You can't recycle your way to growth.
Exactly. The recycling will, I think, fill the void, and I think it's a good thing we should do. If that means we have one less copper mine in the world because we can recycle enough copper to fill that demand, then I think we should. Universally, I don't think we recycle. We're not very good at designing things in a way that we can recycle metals efficiently. But I think, definitely we should go down that path. But it's never going to be more than a small slice of the pie, really.
All right, so let's talk about the exploration strategies of the major miners, and following on, I guess we can talk about why specifically they are always looking for these porphyry style projects, and maybe you can throw in a couple critiques of the way in which they size their bets, or maybe why they're opting to buy versus build projects themselves.
Yeah, so they, as a kind of a general view, there are several copper deposit styles you can go for. And I find, as someone that kind of views this market or has to comment on it, I find that there seems to be very like a bimodal distribution right? That majors only go for very, very select deposits. Like they will go for porphyry deposits. And for people that don't know, what we mean by porphyries, porphyries are like these large kind of high tonnage, big deposits, but they tend to be lowish grade. Like you're talking about like 0.5% to 1% copper. If a porphyry deposit tends to be bigger than that, it's quite a unique kind of deposit in its sense. And for for anyone that's a part-time geologist, porphyry deposits are essentially things that formed in volcanoes once upon a time. So so that's kind of like their link. So majors are like predominantly only really looking for porphyries and these large sediment-hosted deposits like the copper belt in Africa. And there's a fundamental reason. These things tend to be really big, and they tend to have a great profile that they can mine these things for like 50 or 100 years. And so majors aren't interested in copper deposits that are, say, small but high grade. So like things like what Sandfire kind of goes after, things like that in Spain. These tend to be high grade but quite small. Doesn't mean they're not economic. Like they're quite economic, but they're not going to have the mine life that interests a BHP or something like that.
Sure.
And so I think it's like over the last kind of I could say like 10, 20 years, I think there's been a very quite a divide in the industry in that sense. Like we were talking about this. There's not a lot of copper mid tiers now. Like they've all been swallowed. So you have this quite like dichotomy, like, majors will only look for porphyries in a certain type of deposits, and they're only interested in those assets. And then there's juniors who realistically can't build a big porphyry mine at like $4 or $5 billion capex. So they'll go look for these small things. And then that's kind of divided the market really, really clearly, I think.
Yeah. I mean, it sort of seems to come from a place, and this is probably far too blunt an assessment, but bulk commodities tend to make serious money.
Yeah.
And, smaller operations, perhaps they're a bit more cyclical is one way to kind of put them. But you look at all the majors, and it's iron ore, and it's met coking and thermal coal, or at least it has been for a long time.
That's right. And I think, like you can understand, like a company like BHP, really for it to kind of add the gravitas that it wants inside its organization, it really only goes for bulk commodities. And my view is that I think majors really look at copper as a bulk commodity.
Yeah.
Right. So they go after assets that fill their kind of bulk commodity view of the world. Right. Like they're not looking for things that have a mine life for 10, 20 years. They're looking for something that, will exist for 50 years or something.
So we're talking about porphyries. What other sort of styles of copper deposits are out there, sort of for the non-geological mines, and sort of why are they sort of, what are the differences between those and a porphyry as far as the grades and scales and sort of economics you can expect from each of them?
Yeah, so that's a good question. So porphyries tend to be, like I said, it's kind of like a continuum, right? So like porphyries will be at one end, they tend to be really, really big, kind of lowish grade. They usually tend to be not very, they don't tend to have a lot of elements in them. So they tend to be the copper, or there'll be copper gold or copper moly, something like that, which makes them easier from a processing point of view, because you don't have to figure out where all the elements are going. Mm-hmm. And so sediment hosted tend to be on the same spectrum, that they can be really big, they can be also small. That's a genesis kind of thing, like how they get formed. But they tend to be usually copper or cobalt, and they don't get a lot of other elements attached into them.
So these are the Africans, the DRC, the Zambian
that's
projects.
right. Yeah, and
Botswana.
Yeah, and they kind of fit. I mean, like the Central African copper belt is kind of like the type example of them. But there's also like the Kupashifa, which is one in Poland. Yeah. So they tend to be this big deposits that can be mined for a long time as well.
And then we've got the the Spanish examples, the Matzes at Rio Tinto, the original sort of project.
That's right.
Cruces.
Yeah, that's right. So they tend to be more these deposit style called VMS, or volcanogenic massive sulfides. And they tend to be like much higher grade usually on that spectrum. But they tend to have other things, so they're often lead or zinc associated with them, silver, gold, like all of these things kind of come in. So they tend to be smaller, metallurgically, usually a little bit more complicated. Like they're a little bit harder to find as well because they tend to be a smaller deposit to find. So what you find is like, they're the deposits that, smaller to mid-tier kind of companies go after, companies that can't spend, billions of dollars building a mine. And that's the other thing, like sediment hosted and porphyries, the capex required for them from the economic side, it's almost always $1 billion plus that, like you're kind of looking to build. And then, like you have other things like, some people target copper deposits, which are associated with nickel in mafic intrusions. Like that's another end member. So some people target them, but that's like, most people don't do it primarily. They're looking for nickel, copper, and PGEs and that type of stuff that they find there.
Olympic Dam type, IOCG.
Yes.
That's the other one, yep.
Yeah, so IOCGs are another where, like there's some IOCGs that can be mined almost like a bulk kind of operation. And so again, majors are interested in them. I think a little bit of that is, majors go in them, like particularly BHP goes into them because they hold Olympic Dam. So, so it's a deposit style they understand. They understand the processing of it. They understand the complications of it. So, so they go down that path. But so like I said, like, to answer your question, there's deposit styles like IOCG, sediment-hosted porphyry that sit on one end, which are capex intensive, usually lowish grade but high tonnage. And then there's another spectrum, which is more the VMS and carbonate hosted, and a few other deposit styles that fit in there. And they tend to be higher grade but much smaller, but very low capex intensity.
Great. That's a good summary.
So I want to pivot the conversation briefly to commodity price forecasting, and I guess this layers in with what we'd initially discussed. We're pretty critical on the show about anyone's kind of ability, and I mean, we just listening to calls this week, you kind of heard it. I think Chris Ellison said on the MinRes call, "I've got no idea where lithium is going. I certainly didn't think it was going under $1,000 a ton." And yeah, you can kind of see that across the spectrum. Even some companies who pump a phenomenal amount of money into the research side of things get it wrong. And you showed me this fascinating chart, which again will pop up on the YouTube, about long-term copper forecasts. I think they're kind of clumping together a whole bunch of analysts, sort of forming a consensus view. But what's your sort of takeaway in how you think about companies forecasting the price of commodities?
Yeah, I mean, I think as a general statement, I think we do it pretty badly. I think, and that's not just commodity price forecasts. I think if you look at forecasts of other commodities like orange juice and things like that, like similar problems exist in that space as well. Is that generally most commodity forecasts tend to be really good in the short term, but they tend to be horrible in the long term. And it's just because, part of that, I think, I mean, this is just my opinion. Part of that is I think some commodities don't really have a relationship to supply-demand curves. They have more of a relationship to the futures that people are investing in them and speculation of what they think the future price of certain commodities is going to be. I think that's driving commodity price more. But the challenge for, I think, mining companies is that, I mean, the reason why I always like showing this graph is like, when I worked in companies, we looked at consensus price forecasts religiously, right? And we would use those as a way of deciding whether we would build things. And then when I see this graph, which you guys report, and just to explain it, in that graph, the black line that you see is the actual copper price. And the colored lines that you see that end up in the dot are the consensus price forecast of what people thought was going to happen over the next 5 years. All right, so just as a general reference, the black line is what was the actual price. And if you connect all the dots that you see, the blue dots, that is what people thought was actually going to be the copper price in the future. And so you see that there's absolutely no relationship, offset by about 5 years. It's a consensus price forecast. Like, for example, on the graph, you can look at look at December 2005. So just after that, the price was nearly $5 per pound, and the forecast had predicted a couple of years before that it would be close to $1. Right, like that's not really a sound mechanism to actually develop. Like whether you should go ahead with a decision to build things or not. But we used to use these things as like gospel, we could not touch these things at all. And then when you go and look at this, I mean, you go, actually, our ability to predict this stuff is horrendous. Like we're going to be out by a factor of 5. Like, that's not really a good way to kind of operate a business.
Pretty scary thing, right? Because I mean, this is one of the main tools companies are using to make decisions on, whether to develop things or not. And most of the time it's wrong.
Yeah, no, that's right. And so, I guess I don't have an alternative to what you can do, right? Like,
I wouldn't put you on the spot like that.
Yeah, and so this is where I think kind of the problem comes, and to back to like one of the topics we talked about is why do companies why are they buying assets that are, say, producing now versus buying things that could be put into development? Is because you don't know what the future kind of looks like. So it's much better to buy something now, and you know that the price is probably going to be right for the next year. So you know what you're kind of buying and how you can kind of optimize and then go. And if that works financially, I think, then you hedge on the price in the future doing something, and you can then make the alpha that you want on that.
By the time the sales process is closed, most of that year is kind of gone, and then it's all up in the air.
I mean, there's also examples there's a classic example of when BHP sold its coal asset in, I think it's in Colombia, and Glencore bought it, and by the time that the deal actually got finished, Glencore had made so much money out of just the coal price moving that they could just they could pay for the purchase of the mine through just that year's worth of price movement and the revenue they got out of it.
What a champagne problem to have. Because I was going to say, actually, while we're on that as well, I mean, that's also sort of, one reason why we're seeing a lot of people, buying rather than, slash building, discovering.
Yep.
And we saw, so the recent manoeuvres with, the BHP in Anglo, and then it went, BHP Lundin and the Philo assets as well. Do you see that sort of continuing going forward, like that focus of, buying rather than building and discovering?
Yeah, I think so. I think there's more risk in developing these big assets. And I think some of it is perceived, but some of it is real. Yeah, I think it's hard to build these things. It's hard to build them on time, without having cost blowouts and things like that as well. And there's plenty of those, stories around the traps. So I think, so companies I think are now, probably happy to pay a premium to pay for something that's already in production that they don't have to worry about how they're going to make it work, and they can expand it along the way. And that kind of goes back to the research that Richard and Pietro have done, which shows that, when an asset is already there, it's much easier to grow that resource base and add it into production, rather than have to go find a new mine and go through the permitting process of building it and doing all of those things as well. So, so I think people will happily pay a premium now for something that's already in production.
It makes the Philo example particularly interesting because the stab they had at Anglo was for producing assets, but the Philo one is, very firmly development.
That's right. So, it would be interesting to see how that goes along. I'm not completely au fait with what Philo has done from a permitting side of things, or whether they've gone down that path. But I think that's more of a play as well. You've got a number of substantial deposits close by. So if you can kind of put them together, that kind of gives them the scale of operation that probably a company like BHP is looking for. So I think it's more of a play in, how can you kind of put all of these things together, so you're not completely dependent on one asset kind of working. You can kind of make them work in a hub kind of model.
On the point on commodity price forecasting once more, do you think this is something that people from other industries would kind of look in at the mining sector and just not be able to wrap their head around how you can't control, P in your P times Q equation, or you can just be so horribly wrong in forecasting. I guess it just hones in focus on controlling your costs, but that should be a staple in any kind of business. But I mean, do you think there's sort of gaps like that lie in other sectors that perhaps I just haven't spent too much time looking at?
Well, I kind of say this. One of the most challenging things about the mining industry is that the companies are price takers and not price setters. If you're Apple, you can kind of set the price of your consumer goods to some degree, and you can back it up with some level of marketing and things like that. If you had gone to say to someone that you could charge $2,000 for a phone, like prior to the advent of smartphones, like people would have thought that's ridiculous, right? But they have created the marketplace, I think, now that you can kind of do that. Whereas commodities, like you as a company, there's very few companies that get to set their own price, right? So, I mean, companies like Glencore can kind of benefit from the commodity trading point of view on the other side, but you're fundamentally not setting the price for a good reason, otherwise it would be a monopoly kind of setup, which wouldn't work for anyone.
I suppose the kind of saving grace, or one of the factors that the mining industry has in its favor, is that there's probably a lot more continuity. Like if you're getting a world-class iron ore operation, the set of companies that had them 50 years ago are still around, whereas the set of top-tier tech companies, as your example was, is completely different.
That's right. Yeah. So. Yeah. I mean, I think that's that's a really good point in that, I think this is why people like these long life assets as well. Like, they exist for a long time. It's hard to replace them as well. Like, if the Pilbara didn't exist, it'd be pretty hard to replace that amount of iron ore coming from 10 different kind of mines as well. And that's also, I think, this is maybe more of a personal point of view, is that I just think, also if you're the executive of a company like BHP, I would think it's much easier to have one or two kind of assets in your portfolio that produce, rather than having 20 assets that you have to manage and produce the same amount of copper. Operationally and logistically, that's a much bigger problem than, I'd much rather take something like Escondida and just have one copper asset that runs for a long time, rather than have, 20 assets that produce the same amount of copper, but, are at different stages where you got to drill this thing out, you got to expand this thing. That's, I think, a much more challenging kind of operation as well for a large company. I'm
just tuning in late, but has Ahmed mentioned VRIFY yet? He's always been a serial VRIFY mentioner.
He has.
Is there a VRIFY model for Escondida? How good that is.
I've seen the one for Kamalka-Coolah. That's pretty impressive.
Yes. But that's a good one. Well, if it's good enough for Kamalka-Coolah, it should be good enough for Escondida. Mm-hmm. And didn't he say once in a 100-year discovery?
Yeah, one in a 100-year. And if you got people like, Robert Friedland using it, why aren't you?
Why aren't you trying to find the next Escondida with a VRIFY model? Escondida's VRIFY model would have started small. It's grown into Escondida. VRIFY models grow proportionally to how much you drill and find.
You know what Escondida means in Spanish? Mate?
What does it mean?
Hidden.
VRIFY?
I think it means hidden.
Yeah, it does.
Yeah.
Yeah, because it's 500 metres below the surface.
Unlike our love for VRIFY, which is not hidden.
So prevalent.
Explain your story simply.
Go find.
Use VRIFY.
Use VRIFY and go get an Escondida India.
And the VRIFY AI to actually find these hidden deposits.
Yes. Email Grant, and even better, go have a beer with Grant, because he is a GC.
If you're in Perth as well, Nathan.
Oh, big Nath.
Yeah, go see Nathan.
They're all over. They're all over the world.
Yeah. You'll see them at bloody IGAs and everything. They're just everywhere.
Go VRIFY. Yeah, I think it kind of reflects on the management and the CEO and how they are in their headspace and how they think about things. It was interesting to listen to the call with Brendan Harris at Sandfire, and he held a similar view to you there, talking about not wanting to develop Black Butte unless it reaches substantial scale, because it adds another time zone. There's a whole other workforce, a whole other office, and it's kind of refreshing to hear that, because it's like you said, it's so much harder to have all these moving parts around. You actually hone in on BHP, for example, and it's perhaps not as confusing as people may initially think. You've got 2/3 of the revenue iron ore, then you've got coking coal now, and you've got copper. And there's bits they're trying and they're sinking money into potash here and there, but they've done well to simplify the kind of narrative and the story.
I think that's the adage, right? Do less but better, right? Like really know the businesses you're in, and I think that's a much more effective strategy. And I think this simplification also, I think, leads to why, to your comment about geographical spread. I think this is why also people concentrate on certain geographies or certain deposit styles, maybe, is because it's much better. You remove degrees of freedom. So if you're a company like BHP or you're Anglo, you're in Chile, like there's not a huge incentive to go take on the risk of like trying to develop something in the DRC or like sub-Saharan Africa or things like that. Like geographically, like you probably concentrate and become a little bit more conservative because you know that jurisdiction, you know the way of how to work with parties and things like that. Like why complicate it by trying to take on like 10 different jurisdictions. So that I think realistically, if you're a business, you want to take complexity out of your business. So it makes total sense why you want to do that.
I want to dive a bit deeper on BHP. So, Olympic Dam has been there since they took over Western Mining, 20-some years now. And then they've pulled in the Oz assets. And they've recently, for the first time, come out with a resource at Oak Dam. So to start with, what were your thoughts on the resource that came out there?
To be honest, I think it was probably a little bit lower grade than I thought it was going to be. Like I know they have a high grade component, but I thought that high grade component would be a bigger portion of the overall deposit. The overall deposit is quite big. It's it's probably the size of deposit they would probably look at at a minimum. But I think at that depth, like it's probably needed to be a little bit higher grade. But it'll probably still get developed. Like as an asset, maybe in the BHP world, that asset loses money, but overall the business will probably do really well out of having something like Oak Dam in there. Yeah,
and for those curious, the numbers that sort of came out were 1,340 million tonnes at 0.66% copper with 0.33 grams per tonne in gold, and the ore body was starting at 650 meters sort of depth. Something like that.
So around that 600-700 meter kind of depth. But this is where I think there's some synergies in how there's some synergy in BHP taking over Oz because Oz is going through the process of developing Carrapateena, which is roughly the same depth. It's roughly the same grade profile as well. So they're gonna probably learn their lessons there. So hopefully Oak Dam should go a lot smoother because like they've already kind of learned that lesson and have that corporate knowledge to how to mine Oak Dam.
You talk about synergy from an IP sort of sense there, right?
Yeah, because I mean, like a BHP probably as a company, like they're pretty good at large open pits. Like they're not. I don't think they have many assets that do large underground. Like bulk kind of mining. So that's where that expertise from Carrapateena will kind of come in.
Sort of and apply the learnings there.
Yeah, that's right. So and it makes sense, right? They're the same deposit style, same like geological domain, really. It's going to have probably the same level of complexity. So it makes sense.
I think deep, I think underground, I think DSI. And I think of like the deeper you go, the more concentration you need of DSI bolts in the ground to keep that bloody joint humming.
Yeah.
Mate, the bloody DSI set up a factory in bloody South Australia with all this shit happening.
You know how
Mate,
deep Oak Dam is?
Oh,
It's pretty deep.
$1 million a drill hole, isn't it?
Yeah, it was
Something
about
like that.
every drill hole was like a kilometre deep, but I think the ore body starts like 750.
Oh, mate, there's going to be millions of bucks worth of DSI bolts and mesh going in that joint because who else would you buy them off? I'm trying to think. No, I can't think of anyone. It's just DSI.
Thank God we've got them.
Thank God we've got DSI in Australia.
Get
go
on
Australia, go DSI, go Derek Hurd.
Get on the front foot, BHP. And so what are your thoughts, Ahmad, on Sandfire's acquisition of Matsa and that sort of whole Spanish region as well?
So this is like stemming on from our conversation, if you're a company like Sandfire, what type of assets could you go and buy in the copper space? You're probably not going to be able to buy an Escondida or something like that. You're probably not going to be able to buy something like Oz, like the assets they have. So I think, Matsa kind of fits, if I had to recommend an asset that Sandfire would have to buy, that's the type of asset that you would probably go for, along with the company that they bought in Botswana, Mod, so they kind of fit in that right kind of profile.
Very different price tags. That
I
were
know. So I mean, I guess Spain is, from a geological point of view, Spain is it's the belt is called the Iberian Pyrite Belt. It's been mined since the times of the Romans. It's where Rio Tinto kind of became Rio Tinto. And so Rio Tinto spent quite a lot of time exploring that part of the world. They didn't find anything big. They found Las Cruces, but it probably wasn't the right size for them, so they sold it. So there's been a lot of discoveries along that belt. There's about 8 to 10 kind of decent discoveries that were had, but they're not at a size where a major's going to go in and attack them. So I think they're the perfect kind of area for a mid tier like Sandfire, which has growth aspirations to kind of go and take over. So I look at like why would you buy Matza? It's probably worthwhile to buy Matza where you have a processing kind of center as well, so you don't have to go down that path. Then once you have the processing center, it's the old kind of WA gold adage that the person that has a milk and then have gold from all these small things kind of coming through.
The old hub and spoke sort of model. Yep.
So that's I think maybe I'm just saying this as a external person that's I think maybe their angle is that get a foothold, get a keystone kind of anchor, and then a lot of these kind of other deposits start becoming live because you are the only party that they can sell to.
Mm. Are you surprised that we haven't seen any of that consolidation yet, or is that just a factor of how much debt Sandfire kind of took on and the fact that they might need to just, balance the financial side of things first?
I guess, I'm again assuming that they would have probably predicted copper price to have peaked by now, so they would have been able to kind of go and either pay off the debt so their balance sheet looks better, or be able to go and transact on these things. So maybe they're kind of holding their powder dry until the market kind of allows them to expand as quickly or as aggressively as they want.
And actually on that consolidations sort of strategy as well, I mean, do you think, Sandfire or just more generally a mid-tier is perhaps the more capable sort of size company to do that sort of regional consolidation than perhaps a major?
Yeah, I just think like the major it wouldn't be cost effective for them to do like a lot of these small things. Like even things like like when even a company like WMC couldn't kind of hold Kambalda together, like even those assets kind of became too small for a company like WMC. WMC at that time was probably a mid-tier, like maybe a upper tier, kind of mid-tier, but so I think they're just too small. Like there would be so much lost between the seat cushions for a company like BHP to try to put all of that stuff together, that it just wouldn't be worth it for them.
There was also speculation back on Sandfire that they would scoop up Comacao. They ruled themselves out relatively early in the process there, but the company that's ended up buying it, MMG, I think you have experience with back in the mid sort of 2010s. So did you make an assessment at the time of what you thought of the price they paid, the asset and these sorts of things? Yeah,
so I think, you're right. Like I would have predicted if they had gone after like a company like Mod, they would have gone after some of the other assets there as well. I'm not sure exactly why they didn't. I mean, I think they could have gone for it. Like the MMG asset is maybe not the same level as the Mod asset, so maybe they would have gone for that. Like they went for the best thing they could go for. But I'm not sure. Like I think that's also another space. There's a few deposits there that found in that belt. Like they've grown significantly since then. So someone can come along and kind of put that together. But the general view that I have is, I think, in principle, I think it's easy to say people should go and kind of put these things together. But I think the timing of when like the deal window for all these assets kind of aligns, it's kind of like the Swiss cheese model, right? Like all the holes have to kind of align. And I think that's sometimes a little bit hard unless someone goes and is ultra aggressive and is happy to pay premiums to kind of get deals done because they know it'll kind of amalgamate and there'll be the benefit down the line.
How do you think about, given you've got a few years of experience on me, that the timing of, acquiring the assets as well as getting the financing done to develop it, if we're talking about acquiring it?
Yeah, so I think one of the risks that's kind of coming in now is that, as a development timeline blows out, the risk you have is that if you're developing an asset and you miss a commodity price boom, then it's really hard to get that money back, over the time. So I think that's why, people are aggressively going after assets that are already in production, because then when, it's much easier to expand a mine and like and mine more while you're sitting on the asset than having to worry about trying to get a government to hurry up or like trying to push environmental permitting through when kind of the price is kind of booming as well. So so there's always these like windows where I think people are happy to pay that premium in M&A because they know that like when the market flips, like they're in the perfect position to kind of like take advantage of that price spike that comes along. And one of the classic examples of this is like when BHP bought WMC, like for all intents and purposes, BHP wasn't buying WMC for its nickel assets, but they bought it. The deal was done in 2004, 2005, and then 6, 7, 8 was probably one of the biggest nickel booms we've ever seen. So so at one point, Nickel West was probably making more profit than other parts of BHP, just by pure. Not coincidence, but it wasn't probably something that they'd planned for nickel to go to $50,000 per ton, and just be creaming money out. So like the numbers that I heard is like during that time, the nickel business would have like far outpaid any of its costs for trying to buy that business at that time, just over a couple of years, and that was purely because all those assets were in operation, and all BHP had to do was sink the capital to expand them, and they did that pretty quickly, pretty aggressively, and then they were kind of off to the races.
One region we haven't spoken about is Mongolia, with obviously the OT being the flagship asset in the area there. Now that's got a long and interesting history with Ivanhoe and then Turquoise Hill and Rio Tinto. What are your thoughts? Not on OT itself, but on juniors in the area.
In Mongolia, you mean?
Yeah, in Mongolia.
I mean, I think that's a classic kind of case of your question in that it's probably a terrain that majors are probably not going to go into, so it creates a space for juniors to go in, and then and that's I think the part where the really aggressive kind of juniors that are happy to go into those terrains, they can kind of do that work. And that's where I think their space kind of fills in really well, is that they're happy to take that risk. Like they don't really have much on the line, so they can kind of go and do that stuff. And so the question really becomes is, like when the junior finds something that's bigger than its boots, like what are they going to do with it?
Yeah.
Right? Like are they going to be able to raise the money? Like if you're 100 million like market cap junior, and you got to build a mine for $2 billion. Like, how are you going to
How does that work?
Like, how are you going to do even a like 60-40 debt kind of equity thing? Like, how are you going to do that?
Yeah.
Like, you're just going to blow the company up if you go down that path. So I think, like sometimes, like, I think it's like, sometimes juniors say they're going into elephant country to catch elephants, but, you got to be careful because if you catch one, like, what are you going to do with it?
Are you going to get paid for it? On the theme of, juniors rolling the dice in Mongolia, is it kind of right to assume, given the depth and the scale of these elephants that you're looking for, that exploration is a bit more expensive, not to mention the remoteness and all these sorts of things? Is it harder to kind of roll the dice?
Yeah, I think that like this is kind of, I guess, a dichotomy, right? Like juniors are not the best agents to go explore in these areas because it's remote, it costs more, like especially if you add in the depth component, that costs more as well. A junior company that has no revenue and has to raise that money to go and search for things that are expensive, like are they the best entity to go and kind of do this work? So in reality, the best entity to do this work would be a major, because they like they can go spend this type of money, and then it will be a rounding error in their stationary budget, right? So so they wouldn't, like, nobody would care this happened. And
but you have to roll the dice a lot of times to bear the fruit, which is hard to wear.
That's right. So, and this is where I guess I'm a little bit critical about when majors sometimes say that they're looking for these, like when they say they're looking for an escondida or something like that. Is that I think like genuinely, like we've had one escondida discovered in the last 100 years, right? That's probably not a great thing to go and explore for. Like what you should look for is slightly smaller things that could probably become an escondida, right? And that's a strategy that Rio is kind of adopting now. They look for tier 2, like large tier 2s. and they're hoping that they become a tier one while they're working on it along that lines.
Just beat it into shape and make it a tier one asset over time.
Yeah. Or like, like market conditions change and from like it becomes an economic tier one, right? Where you can kind of mine it and then pass it on. But then, like that kind of conflicts with their strategy of having a mine that can just, look exactly the same for 50 years. Like that's a problem for them.
I like that, an economic tier one.
Yeah.
Not a geological tier one.
No, because I mean, once you found the resource, like the resource relatively doesn't change, right? Like it's fossilized a long time ago, right? It's just our economic perception of it or our ability to mine it and all those things that change over time. Like so the resource is a resource. It's if it's 1% copper, like there's not much you can do to get it to 10%, right? Like, like it is what it is.
Do you also think it's a bit of a, let explorers do what explorers do well, and then, when it comes to that inflection point of, the multi-billion-dollar capex bill has come through because they've discovered this big thing, then that's the time for these big guys or mid-tiers or majors sort of to step in, basically.
Yeah, completely. I think it's like, there's a fundamentally different skill set, I think, to go and do like grassroots exploration as opposed to mine development. Like I wouldn't advocate people that are good at doing grassroots exploration to go become mine developers, and I wouldn't advocate mine developers to go do grassroots exploration. Like there's fundamental drivers in that sense. So I think like, so companies that have historically been really good explorers, they tend to be explorers. They tend to hold on to that kind of moniker. Whereas large companies tend to be really good at building assets and building mines and running them. Like they're probably not the best agents to go and explore in certain areas. So I think there has to be that kind of dichotomy. It's just a question of how do you incentivize each party along the path. Like how do you incentivize juniors to do that, or how do you incentivize large companies to accept that maybe they're not going to be the best explorers, so they should create an environment where other companies, juniors, do a better job, but they still get to benefit out of it.
Have you got thoughts on the framework that we discussed with John Ronsky, his aggregator kind of model? Is that something you've spent time thinking about?
Yeah, quite a bit. Like I think John's model is probably a good jumping off point, right? That and John's model really comes from the part of view, and like him and I have had these conversations a number of times, that and we've had these conversations on this show as well, is that the funding model doesn't incentivize people to go find things in an appropriate time frame or to actually find the right things either, right? Because juniors can't raise the amount of money that they would realistically need to go find something. All right, so if you could take that funding imperative out of their hands and you could fund them appropriately, then you could get to a point where they could hopefully be better at what they're finding. And you find this in, like this is not a novel idea. Like you find this in the startup world about, and most of the VCs or accelerator programs that are really good at taking companies through, they fund companies all the way to an appropriate point for them to develop their product. They don't go, we're going to give you $1 million, then, come back to us in a year. We'll think about whether you're doing things right or not, and then we'll give you some more. Like often the best accelerator programs are like, we buy your story. We're not going to give you $5 million to go execute it. Now, if you crash the car along that way, that's okay. We take that risk on, but, we're kind of incentivizing you to get all the way to the end of your kind of product line.
Yeah, and also taking the appropriate amount of bets, right? If you look at like, I don't know, Y Combinator or something like that, when you're taking 2 batches of whatever it is, 20 twice a year.
Yeah. I mean, I did the numbers. So like, Y Combinator has probably got to be somewhere around 4,000 companies now that they've invested in. Yeah, right. I mean, that's over a long time, but still, and out of that, I think there were at last time, I counted there was somewhere around the 3,000 mark, 3,200 mark or something like that. And they had done 11 unicorns, so billion-dollar companies out of that.
You get one Stripe, one Airbnb, a few Dropboxes, and those sorts of companies, and it pays for itself.
But that, like, and you talk to people in Y Combinator, that was their strategy. They were going to take a lot of bets, right? Like that was the whole model, and that means they were going to burn a lot of cash along the way as well. But along the lines, they have made far more back by just taking a lot of bets.
Yeah. We've sort of seen that in the mining world to some extent with BHP's Explore program, which we've sort of spoken about before. But I mean, could you also see that playing out more with majors or mid-tiers doing strategic investments or JVs or, something along those lines into juniors and sort of having the exposure, or some sort of smaller level of exposure, and then sort of wanting to take that further once, say something's discovered or something gets to a more economic size, then they can sort of step in and take it from there.
Yeah, I think, I think there's people that have done that. Like a company like South 32 at one point, I think had so few people in its exploration department that's the model that they had to use. They worked with other companies, they funded them to do the work, and then if it got to a point where it looked interesting enough for them, then they would kind of take over. So people have done those. As a general statement, I'd say people haven't done it at enough of a scale or for long enough to actually see that kind of fruit come through. Like Y Combinator has been running for, it's been like 12 years or something now, right? So they've done it for well over a decade consistently.
Even longer, I think.
Yeah, I think so. Yeah. I mean, like it's at least a decade old, right? Like it's got to be more. So like you said, they take 2 cohorts every year, without fail. They fund them, they go down that path. And if you look at, like the early years, they didn't have much success for a while, because they have to get their own ecosystem of how they're going to help founders to kind of go down that path. And so I think, like one of the things that we haven't been very good at doing here is that I think people do it for a while, but then when they don't have early success, I think it's harder to maybe justify running them, and people end up bailing out of them. So I think, like maybe a bit of residency time in those would be good as well.
Yeah, it's fascinating how many sort of things could be learned from a process like that. Like it's very structured in that they always took 7%. I forget what the exact number was.
Correct, yeah.
They might have been like...
They pay you, I think it's like, these numbers might be changed now, but they pay you $125,000 to get 7% up front, depending on what stage of company you're in. Yeah. And if you meet a certain hurdle, then they'll put in another amount, which is again for another 7%. Yeah. So all of these things are kind of fixed along the way.
And then they pass you on to the set of growth investors, and they make that sort of connection.
That's right.
Quite simple. Yeah. I mean, the idea of a group of these sort of wealthy individuals as well as endowments and everything to potentially come into the mining industry and change the game. And, another feature then being private companies is another attribute where you see the markup in valuations is, a much smoother line. It might be an artificial line. But it's another potential learning that could get investors more comfortable with.
That's right.
With mining. So
this is back to like John's kind of aggregator model. This is something that, I think him and I both agree with, is that I think some of the early capital will probably be better to be private. I think it's hard for junior companies to go and do, such risky things and have to provide market news and all of that type of stuff. I think that ends up being maybe a distraction, not just in their execution, but also financially ends up being a distraction in the amount of money they raise and things like that as well.
Probably not the best use of their capital as well.
Yeah, I think, it's not the best use of their capital if they're not appropriately funded. If they're raising, $3 million for, say, 3 years, half of that money is probably going to go into listing costs and all of the other things that they have to do, like auditing and all of that stuff. Is that the best use of kind of like money in that sense? And there's people that have looked at, how companies have spent money. And what you find is that, in an environment where capital is not that available, like the part of the company's cost that get cuts is the in-ground spend. The rest of the stuff has to be a baseline cost that has to be maintained.
Keep them going.
Yeah. So then, so in times where capital, when people think capital is least efficient and then they take it away from the market, you actually incentivize the companies to become even more inefficient because now they're just spending that money to just survive for the next little while.
The time as well, the amount of time that a geologist running these companies might be spending on the road trying to drum up more capital, if that could, and it's there are similarities with private companies. They still need to raise money and stuff, but
that's right.
The amount of flow-on benefits, and we do have a lot of the things that the US have. We have got wealthy people, a phenomenal superannuation system here. We have the mining expertise.
Yeah,
it'd be.
The one fundamental difference again is that the amount of the quantum of money that it takes to get to a decision point as a junior exploration company on a project is quite a lot more than what a lot of startups can do, right? So that I fundamentally understand that. Especially if you're like a technology company that does a SaaS product, like a software as a service product, like you're talking about a few $100,000 to get to a point where you could have a product that you can take to market and do that. That's probably not realistic in exploration. You're talking about a few $1 million to get to at least a minimum kind of output. And so to back to John's kind of model, that's part of the reason of the aggregator model was that it's like, if you're going to have to spend this much money to get to a realistically conceivable proof of concept or key decision point, why wouldn't you try to make that money as efficient as possible rather than wasting half of it on listing fees and all this other stuff that goes on?
Beautiful, Ahmad. I think we almost solved all of mining's problems there.
Yeah.
But thanks again for coming on. It was great to chat about copper, and I'm interested to see what we chat about next time.
Sounds good. Thanks a lot for having me again.
Cheers, Ahmad.
Also, a huge thank you to Axis Mining Technology, Mineral Mining Services, VRIFY, SMEC Power Technology, DSI, Underground, Silverstone, CRE Insurance, Greenlands Equipment, K-Drill, and use the Spark chart while you're at it.
Hoodaroo, money miners.
Hoodaroo.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.